we're going to start, and that's an exception today, with the slide 26. And if you have to just remember one thing today, is this slide that I'm showing you here. When we talk about gold, when we talk about gold mines, we always talk about macro environment. We talk about inflation, we talk about rates, we talk about the US dollar, and this is exactly what I'm going to be doing for the next 15 minutes. But before I do that, I would like you to look at this graph. This graph is basically showing you how gold performed when the Fed fund rates pause. And the only conclusion you should draw from this graph is that gold goes up by 50% each time the Fed paused. We're not talking about higher rates down the road, we're not talking about lower rates down the road, we're talking about the Fed pausing. And this is exactly what happened for the last couple of months. We had, of course, discussions, the pros and the cons, what is the Fed going to do? But our scenario, which has always been the same for the last 2 years, was that we had reached peak inflation, we had reached peak rates, and we had reached a peak in the US currency. So when the Fed pauses, gold goes up. And it's exactly what happened this time around. That's the normal disclaimer page. And here is what we're going to be talking about. As I said earlier, our theory was we have reached peak inflation, peak rates, and peak USD. And since September, or the summer of 2022, which is when we made this statement, this is what we have observed. The yield curve has gone from minus 70 beeps to minus 100 beeps, and now is reversing. And you want to see a yield curve reversing because this is a sign of a recession coming. So this is exactly what has happened, and it's on the path for the economy to slow down. Recession or not, we don't know when it's going to happen, but it will happen. We also noted a deceleration in inflationary pressures. Everybody's talking about inflation, rightfully so, and we're going to see it. You have some sectors, the service sector, sometimes on the good side, but this is on the supply side. We have those roots of inflation that are still popping, but as a general rule, and the trend is in this case showing you that we have a deceleration in inflationary pressures. And we're going to see it in a graph later on. The leading economic indicators, well, they are still negative, and we're going to see it in a graph. And we are living today in an environment where we have the most restrictive monetary policy. So these are terms that maybe all of you are not familiar, but remember, all these bullet points are to demonstrate one point, one single point, is that the economy is weakening. And if the economy is weakening, it means that rates will go down because inflation is decelerating. Number of job openings is another example. The inflation on wages is another example. Net income of households has stopped going up the roof. Their savings are going down. But despite all those examples I just gave you, there are some doubts. Are we going to have a reacceleration of growth? And this is nonsense. This is nonsense because if you see what happened in the last 3 quarters of the US economy, you will notice simply that growth has kept declining, weakening from 5 to 4 to 1.5%. So, all in all, in this environment, and this is factual, we're going to see interest rates go down, inflation is decelerating, and the Fed will ultimately lower its rates. And this is why gold has gone up. This is why gold today is trading at $2,400. So, remember 2001, 2007, like I showed you in the first graph, 2019, and today, each time the Fed paused, and this is the only message I want you to remember today, gold went up. So what about gold mines? Remember one thing, gold mines are highly correlated to the price of gold. The historic correlation is 80%. And I'm sure that the perception of the retail investor is that when gold goes up, gold mines go down. The reality is completely different. The reality is that in 80% of the cases, 80% correlation, this is huge, gold mines perform like gold with a higher leverage, of course. So, and the leverage is about 2 to 1, 3 to 1 on average, and we'll see it later in a graph. So, why would gold mines outperform gold? Only because their profitability is going to increase. The market is never going to pay for a gold mine if the fundamentals are not improving. As simple as that. And if you look at the price of gold in Q4 2023, and if you compare it to the first quarter of 2024, and if you compare it, that Q1 2024, with the average gold price for that second quarter in which we are of 2024, there was a $100 difference between Q4 23 and Q1 24, and there with, assuming gold stays at these levels, there will be $260 above, on average, above the Q1 number. So, and since finally we are seeing a stabilization of costs, operating costs, you obviously can draw the conclusion that the numbers and the profitability of those gold mines in the second quarter of 2024 will be much higher than the sequential quarter of 2024, first quarter, and the fourth quarter of 2023. So this is the theme. Gold mines are going to outperform gold because gold has a natural terrain for outperforming. And this is what we have been observing for the last 2 months. Just to remind you, gold mines have gone up by 40% in the last 2 months. 40%, and nobody has noticed it. Nobody. But everybody's talking about gold. Gold at new historic high, 2,300, 2,400. You mentioned 2,420 today. I didn't look at the numbers, but the reality is that finally those gold mines are going to be able to show better profitability. And that's all it takes for them to outperform the underlying asset. We're going to go through those graphs quickly, but that's a graph over the last 2 years, and this shows the inflation expectations, the way the market sees inflation. So inflation expectations have come down, and it's completely opposite to the feeling that, or the articles that you read about the fact that inflation has come back. No, inflation hasn't come back actually. Inflation is still trending lower. And these are the rates, the 10 and 5-year US rates, which have gone up and have really surprised everybody else. And this is when gold didn't do well, because we kept thinking that we had reached a top in nominal rates, but we haven't, and we haven't until we peaked in that in that month of 2023, and since then, finally, the market is realizing that inflation is not a real concern anymore. That's what the market is telling you, and that the anticipation for inflation are going down, and the US dollar is, well, the trend has been down. And this is what you need to remember: dollar, nominal rates, and inflation. And that's the recipe for a higher gold price. That's the flattening yield curve. You want to focus on the inversion of the yield curve. Each time you have a reversion of the yield curve that had inverted, you had a recession. I was talking about leading indicators, and here they are, still in negative territory. And each time you had those levels hit, you had a recession. This is another indicator, the Philly service business outlook. And again, we are in negative territory. This is not a sign that the economy is growing or that the economy is improving. Despite all this, as I said, the perception is that the growth is picking up. But as you can see, there are very, very volatile indices, benchmarks. So what you see here is not an indication of the final result. Same for the weekly average weekly hours in the US. Well, when that number is stagnating, it's not a good sign. It's not a sign that the economy is growing either. And when you have those labor numbers that are coming, that are being published, just remember one thing. This is it. The part-time. Companies in the US have hired part-timers. They haven't hired full-time employees. So the statistics of that labor market are twisted and are sending the wrong signal. One good number is this one. Well, consumers are still consuming, and that's why you speculate, and people are speculating about the strength of the economy. But the reality is that the economy is slowing down, and the last quarter, I remind you, was half the anticipated number. Consumer expectations, well, the picture is not very reassuring. And wage, which was a main component of the inflation numbers, well, it's still close to 5%, but it kept going down. So just remember that the trend of wage inflation is slowing down. We are still at the 4.7%. That's still very high, but it's going down, and this is what we want to see, and this is what the authorities want to see. And when I was talking about monetary policy that is impacting the perception of the market, look at the spread between the S&P 500 and the spread of the 10-year. So basically, the difference here has never been this high. And when you have such a huge discrepancy between these two returns, something is going to happen. So the S&P 500, you know what it has been doing over the last few years, 5 years, 10 years, but the yield on the S&P 500 is so low and the nominal rates are so high that at some point they will reconnect. And they will reconnect only when the economy slows down, and the economy is slowing down. And this is why our thesis is that, which is factual, that when the economy slows down, rates go down. I won't bore you with this slide, but in a nutshell, this is the service of the debt, US debt. So we have reached the level of the late 70s. So this level of debt, we're not going to get rid of it, but this is why rates have to go down, because otherwise that expense pocket will cost too much for an economy to continue growing. You remember this graph? But this is a graph that I show all the time. It's about restrictive monetary policy. We have never had such a restrictive monetary policy for the last 15 years. When a monetary policy is restrictive, it impacts the economy and the economy slows down. That's the savings we talked about. So now we are in negative territory. And the reason why gold kept moving in a volatile way until the last 3 months, it's because of the expectations of the market speculating on where the Fed fund rates would end the year. So this is where you want to see the expectations and the probabilities of each of them, and the Fed funds rates ending the year. So we moved from a probability of 30% with Fed funds rates at 4.25 to Fed funds rates at almost 5%. And now we're back to what I consider to be a normal phase of a good correlation between the anticipations of where the Fed are going to end the year, the Fed fund rates are going to end the year, and the reality on the ground, the economic reality on the ground. We're going to keep this. That's the CPI. And this is one reason why people are speculating on why inflation is sticky. And that's the 1 month PCE annualized. This is the 6 months PCE annualized. And this is the 12 months inflation. And just focus on what is happening here. Okay? So the numbers are not very convincing. And this is why you still have doubts about where inflation is heading. But we don't have any doubt where the inflation is heading. From a supply side or a demand side, we can draw the conclusion that because of the savings going down, the demand is going to slow down like it did over the last quarters. And the supply is not an issue anymore. Supply impacting inflation is not an issue anymore. The only element that is still pushing inflation, maintaining inflation at these levels, is the demand. And this demand is not I mentioned correlation, negative correlation between real rates and the price of gold. And this is exactly what happened over the years. So you've got the price of gold, and you have real rates. When the price of gold goes up, real rates go down, up, down, up, down. And right now, there is a lot of speculation about why real rates are going up and gold is going up. But to me, this is really a period of time where we shouldn't focus on. We should focus on what I said earlier. It's expectations for lower inflation and for lower rates. This is exactly what it's telling us. Back to the slide that I showed you in the intro. And gold mines. I have just a few minutes to talk about the gold mines. But how do gold mines behave in a turbulent stock market? Well, remember one thing. They go up each time there is a correction in stock market. They outperform all the time. They outperform the S&P 500. In this case, we could have taken the Dow or the Russell. So after a recession, the first class of asset that is going to outperform stocks, it's going to be the gold mine. So this is where you want to be. You want to be invested in the gold mines. Production is flat, more or less flat, and one point about gold is to mention the fact that ETFs, gold is going up, but ETFs are still, the demand for speculative investments is still very, very negative. So when this number is going to start turning around, you will see an even higher price of gold. Right now, the speculative demand is still negative. The last 2 weeks showed you a demand that is popping up, but right now it's still negative. So imagine what could happen if this side of the equation, of the demand equation, is going to turn positive. Gold will ultimately have to go higher. And since I'm running out of time, I will say one more thing. People who don't understand gold mines don't understand that they have always outperformed the underlying asset, always. And this is exactly what we see here. Since the beginning of the bull cycle that started in 2016, gold mines were up 200%, and the price of gold was up 117%. So keep that in mind. I have to leave the floor, but we'll be back, or I will answer more questions later on. Thank you very much.